Welcome everyone for another episode of the Endeavour Exchange, where my colleague and I, Grant White, are going to be talking about all the trends affecting your money. So thank you for tuning in today. We're going to kick things off here, Grant. You know, valuations are extremely high. We've been seeing some interesting activity in the markets as of recently. And so the first question I want to pose to you is there a stock market bubble? And if there is, when will it burst?
I think that generally speaking, whenever somebody starts talking that there's a bubble, it's not a bubble or it might not be a bubble like anytime soon. But I mean, I think that's just the nature of, how the markets work and how these bubbly type events happen. But I think it's safe to say, man, like the valuations are high as you mentioned. And I know we've got a chart to look at here, but when you look at like the future PE, price earnings ratio versus the current one, it does look like the pricing is a little bit frothy out there compared to where guidance is kind of looking over the next 12 months. But in saying that, I mean, this has been going for a little while. We've got record low interest rates that are fueling it. We've got cash savings on the sidelines. We know that. Yeah, I'd say the valuations are high, but I mean, there's nothing to say that can't carry on through the remainder of 2021, and especially as economic growth continues to pick up steam throughout the year, in which we're expecting to in the second half. So, it's I guess to answer your question, it's bubbly, but it could get more bubbly.
Yeah, I would have to agree, and even if it is, it's one of those environments where, what do you really do about it? I know for us, it's about maybe playing a little bit more defense and being very, very selective of the assets that you're willing to touch. Being very aware of a company's credit and debt levels. So that in the event that there was some sort of economic downturn from here or crisis, you could say that some of the businesses that you own are able to weather it. So it's one of those things where, what do you really do about it? I don't think the answer is getting out altogether, because you're right, we could see this get even bubblier and continue to move forward another 2, 3, 4 years from now, really.
Yeah, I think so. And I think that, that's been kind of our mantra since the beginning of this, is just like, you need to be choosy with the companies or the assets that you're buying. And I wouldn't just be buying a blanket out there right now, because there is a lot of frothiness. But, you bring up a good point, because like, is it time in the market versus timing in the market? And I know a lot of people, I get emails almost daily right now, people trying to time the market and trying to like, oh, well, we'd like to just get a quick win on this. Why don't we just invest in this for a quick win?
Yeah.
What do you think on that?
Well, as you referenced there, it is impossible to time the market perfectly. And with that, even if you get the timing right by luck, you're able to get out before you see a major drop. The best days in the market typically happen right after some of the worst. And after a bad day in the market, it kind of makes you feel real, like you feel those losses. And as we'll see throughout 2020, what can be considered an extremely volatile year, it was much of the same. We saw these large pullbacks that kind of scared people out of the markets, or they didn't want to invest. But then it was followed by a number of up days. So I wanted to bring up a chart, because you mentioned there, is it time in the market versus timing the market? And we have some data here from 2009 to 2019. Taking a look, we talked about those best days, and they happen after those worst days. So what happens if you miss those best days? So we have this chart here that looks at, as I referenced, March 9th, 2009 to March 8th of 2019. The S&P index over that period, obviously this was just after the 2008 financial crisis, so you're buying at some pretty low lows there. But the S&P index from that point on did an average around 17.5%. So if you had invested $100,000, you're looking at that being worth about $500,000 today. If we look at what happens when you miss the 10 best days, that returns down to 12.1%. And if we kind of skew all the way to the end of the chart, miss the 50 best days, and you're looking at you're earning less than 1%. And if you look at those numbers, $100,000 would have turned into 107, a $400,000 difference in this case. So the point of this is really like if you have that money and you're this person that's trying to go completely to cash because you're trying to time things and get out of the market, you're going to hurt yourself because you're going to miss those best days. And I thought, as I referenced 2020, volatile year, we've had many conversations with prospective clients where, in March and April, they decided to go to cash and they wanted to sit there and let things become more clear. And as we've seen through the data, it's almost always the wrong decision. If you went to cash, you miss some of the biggest gains we've seen in the market, in some time. And so what I wanted to pull up here was a second chart that takes a look at the daily changes in value of the S&P 500. I pulled days that saw movements beyond 1.5%, either up or downwards. And again, as you'll see from the data here, if we just look early in February there, 2.8% down. In the next couple of days, we're looking at just under almost 4% gain. Move even further if we look into March, March 3rd, down 3%, March 4th, up just over 2.5%. Go into later into March, where we look at March kind of 23rd, down 2.38%, and then you see this rally through the end of March, early into April with these big up days, 4.2%, 4.9%, 2.58%. Again, missing those best days, as we have seen from the data, creates a real drag on your portfolio, and being able to time when to get in and get out, it just doesn't work. So it's about more so as things get bubbly, playing a little bit more defense than maybe you are offense, having a little more protection built into the portfolio, but it's not about getting out entirely. You still want to own those businesses because ultimately we could be wrong and the market can go on for another, like you said, get even bubblier for another 2-3 years. And even if we have those bad days, we know that they're going to be followed by some of those bigger days. So a better strategy is just staying disciplined to your approach.
What's the line from Batman? It's the days often, or the nights often darkest before the dawn, right? So that's I think that applies here as well. But I just stop trying to time the market. Stop listening to what your neighbor or your Uber driver did. Stop. None of that matters for the long term, successful investing.
Even the media headlines, right? It's doom and gloom sells. It's way more shocking. It's way more concerning. No one wants to lose money. But at the end of the day, you're losing more money by trying to get in and get out. It's about having a good strategy in place, having an understanding of that strategy, and then remaining disciplined to it. So, Grant, it's that time of year, RSP season. Everyone's talking about it. So I figured the next question that we could throw out there are, what are the most common mistakes with RSPs?
Yeah, well, there's so many. So actually, I took a quick list down because there's really a lot. If you talk about the most common, I think that for the first and foremost is investing inappropriately in the RRSP. We see a lot of that where people are holding in depending on their plan the wrong type of asset in the RRSP account. And there's a way to be more tax efficient with your overall plan than what most people are doing. So often, for example, we'll hold more interest-bearing investments in the RRSP because everything that comes out of an RRSP, once it's converted to a RIF or even before, it's coming out as taxable as income anyway. Mm-hmm. So it's taxed at the highest rate. You might as well have your highest taxed investments in there and save your lower tax investments for other accounts where you might be actually paying tax, like your non-registered account. You want your capital gains, for example, in there. So, we see a lot of that. We see a lot of people rushing the contribution because they haven't planned for it. So rushing the contribution right at the deadline, mm-hmm. and then the money doesn't get invested for a period of time. So that can be a mistake as well. You're sitting in cash way too long. Over contributing. This has become a really common one we've seen, and it is costly. I mean, you're paying 1% per month when you've over contributed to your RRSP. Yeah. So it becomes very costly. It's a huge pain to get the money out. There's forms to file. There's things to do. It takes months and months, and on, especially right now when so many organizations of the government are dealing with COVID-19 situations, et cetera. It takes quite a while. So it's very costly. So be really careful what your contribution rooms are before you're making your contributions. And I think like over contributing to the RSP in general, not even going above where you're getting a penalty, but like people just putting too much money into the RSP without understanding the consequence of what that means for themselves down the road, like 30 years from now.
Hmm.
What does that mean for their estate plan? And we pull up a lot of plans where we're seeing hundreds of thousands of dollars being left in RRSP plans now converted over to like RIF accounts or registered retirement income fund accounts, but they're still taxable at death. The death of the last of the surviving spouse, if it's a couple, that becomes taxable to the estate, and so you almost cut a check for half of that to the CRA at that time. And so now there's ways to mitigate all that, but you have to have a plan in place.
Hmm.
Um, and I'd say that's probably the final thing is like a lack of a plan. People are piling money into RSPs, and RSPs are great. They might be the best accounts to use, but tax-free savings accounts are really great as well. And so there might be a combination of the two, or maybe tax-free savings accounts are a better approach. It really just depends on the individual situation and having a plan. Because if you deposit into an RSP, and a lot of people have been told to just do RRSPs their whole lives. But what if you need the money on a shorter term basis and you're
Yeah.
pulling it out, paying tax on it, and you're kind of defeating the whole purpose of the RRSP plan in the first place?
Well, as you mentioned the over contribution there, I couldn't help but think about why it's important, or how important it is to make sure that your professionals work with one another. So your accountants, your financial advisors or planners, investment advisors, that they're aware and that they're speaking to one another, because that's, when we see these over contributions, a lot of the times the case is that these professionals haven't been working with one another. Your advisor hasn't been working with your accountant, so they have no idea what you're able to contribute, or even what your true situation is. So again, that team approach, that where your advisory team works with the other external professionals, so important to avoid these type of costly mistakes.
Yeah, no, 100%. I think the estate plan is the really big one, and again, you're right. Working with the accountant, the tax specialist to make sure that everything is as efficient as it possibly can be today, 10, 20, 30, 40 years from now as well.
Absolutely.
So let's talk commodities a little bit. Let's talk about canola. What's happening with the canola price?
Yeah, I figure this one's a good one for, in Manitoba here. We have a lot of agricultural businesses and a lot of farmers out there. In short, the price, it's going up. For commodity experts out there, I apologize for any oversimplification of it. But really what we're seeing right now is a China-fueled kind of global buying binge, and it ultimately has things like canola is used in things like vegetable oil, processed foods, animal feed, and it's causing Canadian stockpiles to dwindle, which has led to now fears among a lot of traders out there that there's ultimately going to be these shortfalls in the current season, as other countries beyond China are also stepping up their own purchases. And so the price, as a result, we'll see here from a chart, has reached its peak since 2008. Hitting very close to, this is for a futures contract, very close to $700 per metric ton here, as we'll see from this chart from Bloomberg. And so I'm sure many are aware, especially the individuals who are involved in a business like this, but Canada is the world's top exporter of canola. About 90% of its output is shipped to 50 different countries. The crop here in Canada supports 40,000 farmers and contributes about 26.7 billion yearly to our economy. The roots of this shortage trace back to autumn, when the farmers actually had one of their smallest harvests in 5 years. So less supply there. And then we've seen a strong export demand for canola seed and oil that ultimately drove a late summer rally that prompted the farmers to sell more crop earlier than usual. They've locked in these contracts at these higher prices, but then they also risk losing money if the prices go higher, because if you sold at X amount of dollars and that price goes even further, well, you ultimately could have sold at a higher price. So something I'm sure that many of these commodity traders and producers here in the province are paying attention to very, very closely. So it makes for a very challenging environment, because ultimately you have to make the decision. Are you locking in at this higher price, or are prices going to, as supply kind of gets even tighter, are prices going to go further and further and further, and you actually could have sold at that higher price? So challenging environment, volatile environment. I'm not a commodity expert here, but from what I understand and some of the individuals I've spoken to, this is a very volatile market and a challenging one. It's good that the prices are high, but it makes it challenging when you're trying to hedge those contract futures.
I got nothing to add on that. That's pretty interesting. Yeah.
Well, this one I know you'll have lots to add to, because
Yeah.
we've had many conversations in the office here about what's going on, and this has been, the news headlines for the past 2 weeks. These companies like GameStop and a lot of other retail names. But what I wanted to talk about today, because it's not getting talked about a ton anymore, it's kind of quieted down with the price of GameStop coming down, but there were some interesting things that occurred during this we'll call it this short squeeze that we saw, and one of the questions I wanted to ask is, how will the regulatory environment change with what occurred with GameStop?
Yeah, I think that's the $1 million question as it relates to all this, and I know that there'll be lots of people. There are lots of people looking at, is this right, and how this all played out with what happened on Reddit, on the Reddit forums. And I think that's I think that's a leap, to be honest, to say that there's going to be some sort of, I know they're going to investigate it, but I think it's going to be a leap to say that there's going to be some sort of reform against what happened there, against the individual investors themselves. But where I see the regulatory requirement potentially changing is on the platforms themselves. And truthfully, I think that would probably be prudent. I think that would be responsible. I'm all for the freedom of allowing people to invest and evening the playing field between Wall Street and Main Street. I'm totally in favor of that, and I think that the technology and these platforms allow that opportunity. So I think that's really great. I am not against these platforms whatsoever, but I do think that there is a element of responsibility that needs to be taken, because there are certain types of investments and investment strategies, like you can get into options, you can get into a whole bunch of different things, that if you don't know what you're doing, you can get yourself into a lot of trouble very, very quickly. And I think that has huge ramifications against individuals and their families. And so that's where I think that the regulators need to be looking at. I'm open for this openness. I'm open for the ability for people to have that same opportunity as a hedge fund manager on Wall Street. I think that's great. But I do think that it's dangerous at the same time if people are handed essentially a loaded weapon and they don't know what they're doing with it. And that's essentially what's going on right now. And I think that this whole GameStop situation, and you could throw the other companies in there, that's really highlighting the power of these platforms and the power of people using even like Reddit as like a forum to like communicate and work together on these. But it's also highlighting the need for the fact of more financial education for individuals, and I think also the potentially a fiduciary duty for the platforms themselves. Like I won't name names, but the direct trading platforms where these individuals are able to go in and trade, and if they don't know what they're doing, they're going to get themselves in some hot water very fast. So I think that there's an element of responsibility that needs to be put on the platform to make sure that people cannot get into so much trouble that they lose their shirt on it. Now, I'm not, when certain platforms were blocking trades and were stopping their people from being allowed to do that. Now, there's other circumstances I think involved there, and I won't get into it on this because we just don't have enough time. I didn't necessarily think it was great that they were blocking people from buying more, because again, it went against the whole idea of the platform in the first place. But there was other circumstances behind the scenes that needed to be taken care of. So I think that that's not necessarily the approach to it, but I do think that there has to be something in place to make sure that people can't get in over their heads as it relates to investment strategy. We cannot have just a wide open, Wild West type of situation, because people it's too complicated. There's too many things that can go on. There's too many moving parts, and people could get exponentially hurt by some of these investment vehicles that they have access to.
You won't go into it, but I'm going to go there because I think there's some other things worth talking about. Initially when we saw Robinhood and some of these other platforms, prevent individuals from buying more, the idea was like, oh, here it comes, the hedge funds and the corruption and things like that. When in actuality, it was actually a margin call by the clearing houses that they told the broker Robinhood they have to slow this down. And for those who are unaware, clearing houses, so when you buy or sell a stock, it settles on what we call T+2, so today plus 2 days. During that period, the clearinghouses, which help settle the transactions, are responsible for basically taking all these buys and sells, packaging them together, and ensuring that they settle properly in the proper accounts. And with Robinhood and some of these other platforms that allowed these to be bought on margin, that period there, if Robinhood doesn't have the money to settle the stock because the stock price plummets and they've lent it out at a much higher valuation, that clearinghouse is exposing themselves to a lot of risk. So it was these clearinghouses that really came in and said, hey, this needs to slow down. But then, to the question about the regulatory changes, I know that this has now, what's happened now is there's it's fueled the debate that we've seen before, and it's whether these clearinghouses, that are supposed to be a stabilizing force, how they can actually contribute to risk in the financial system. And I know last week we heard from the Robinhood chief executive, who called the 2-day time frame, that T+2 settlement, and he's calling for it to be replaced by real-time settlement or immediate processing of trades. And we can go down now. There's this idea that blockchain is a possible technology to solve some of these things, but I know the clearinghouses have said that they're definitely in favor of speeding up the settlement cycle, so we may see that. Though they've argued against the next day or same day settlement rather than for kind of next day or same day rather than real time settlement. I know just in the past it used to be T+3 and it went down to T+2, and it's a very big adjustment for a lot of for the financial system as a whole to get the systems working and speaking together properly. So we may see some. I don't know if it's regulatory changes or it will likely come with regulatory changes, but there may even be changes in the future to how these things are being transacted and settled and whatnot with newer technology. So something to keep our eye on.
Yeah, and again, I think it all just comes back to the individuals, though. At the end of the day, Wall Street is going to be fine after this. And I know that this was a bit of an attack on Wall Street, if you will. Wall Street will be fine. And whether you like that or not, they will be. They're going to be fine. And in fact, a lot of Wall Street made a lot of money during this period of time. So I understand the point behind all this. At the end of the day, I think that this ends badly for a group of retail investors. And once again, it's the little guy that gets in trouble. And it's because there's been systems in place that did not protect them appropriately, in my opinion. And I think that the platforms themselves, it's great to go out there and say, we're going to democratize the world of investment. That's great. It's really great. I love the idea. But without a plan for protecting people, opening it up to the Wild West, it's doing the exact opposite for a lot of people if they don't know what they're doing. So anyway, I'm in favor of the whole thing. I'm in favor of, leveling the playing field, but I do think there needs to be some checks and balances in place to make sure. And this is no different from any other part of society. There's a lot of other things that we do to protect people from themselves. This is the same kind of concept. I know there's going to be some people who don't agree with me on this, but this is the exact same thing as we do in virtually every other aspect of society. We don't let people just drive as fast as they want to. Why? Because they can get hurt. They can hurt other people. They can get hurt. So that's why we have speed limits. Think about this like a speed limit on the investment platform.
I feel like you're getting heated at me here, Grant. I'm
not heated at you. I'm heated at the whole situation. I think that
I know we watched it and we received the texts from friends and other individuals we know, and it was just from the very get-go. This was an event that has been seen in history before, just not with the technology and tools that people had at their disposal. So I think from the get-go, we knew it was going to be very quick upwards, and when it came down, it was going to come down. So very quickly.
The technology is awesome. I have to say, the technology is awesome, and the thing is, the innovation is so good. It's getting faster and faster and better. But unfortunately, it opens up doors that maybe shouldn't be open just yet. For people, I think that I don't know. I've been harping on this for years that people need better financial education, and this is part and parcel of it. The problem is, as the technology gets better and better, the problems become bigger and bigger as well in certain cases. So I'm just hoping that for some sort of thing that will help protect people a little bit from themselves. Like I said, have a speed limit. Doesn't mean you can't do it, but have a little bit of a speed limit thrown onto the platform to make sure you can't get into trouble, or maybe certain people can drive a little faster than other people can, if they have certain knowledge, those types of things. But I'm not a regulator. It's not going to be up to me to make these rules. I just think that, at the end of the day, we're here to protect people as well. And I think these platforms do the same responsibility that the rest of the financial services industry is. So.
Well, it was definitely a wake-up call for a number of individuals in the industry. But with that, Grant, we'll wrap things up today. So thanks again for everyone who tuned in to the Endeavour Exchange. We look forward to being back here with you very, very soon. You can visit us at www.endeavourwealth.ca. All the advisors' information, contact information is there. We have we put out weekly original content on investing, personal financial planning, so you can take a read through some of the blog materials. Check us out on YouTube, Facebook, Endeavour Wealth Management, and if there's anything you need from a investment portfolio review to talking about your financial plans, you'll find all that information on our website. So thanks again for tuning in, everyone. Look forward to catching you guys next time.